Investing with IBD is brought to you by AllianceBernstein, a global investment manager offering active, flexible solutions across asset classes. AB has the tools and expertise investors need to get their portfolios ready to navigate late cycle investing. To find out more, visit abfunds.com. Okay, hello everybody, and welcome to Investing with IBD for May 1st, 2019. I'm your host, Rusha Pierce. And back in the studio, once again, we have Mike Webster, Senior Vice President, Portfolio Manager of O'Neill Capital Management. Thanks for being here, Mike.
Hey, thanks for having me back.
On today's podcast, we're going to talk about the market, IPOs, and current stocks. So, Mike, let's get right into this. Let's get into the market. And as we know, it's been an incredibly strong market. We are in a confirmed uptrend. Mm-hmm. 2 distribution days.
Yeah, back
on
to back.
both the NASDAQ and the S&P 500. So we've had distribution days fall off, too. Mm-hmm. And the markets are at all-time highs, or right near. They made all-time highs. They got through 8,000. But maybe we're due for a little bit of a rest here?
You know, it kind of feels like it. Midday today, with the Fed talking, things started selling off. And Powell has a way of kind of killing good things, unfortunately, if we go back to October. So hopefully this isn't long-lived and we just maybe come down to the 21-day and bounce off. We might not even get that low. That's just a little bit under 8,000 on the NASDAQ. But it feels a little like, like stalling type of action with stocks. You saw a lot of stocks gap up on earnings and then come in and close at the lows. We saw a number of big stocks do that today.
Right. Yeah, we felt it personally in some of those stocks.
That wasn't fun.
No.
So it was a bad day for like our style of stocks, and it kind of feels like we might just have to stall out a little bit. It doesn't look like the end of the world, and the long-term 1949 to 1966 precedent that we talked about last time, that's still fully, intact and everything. But things don't just go up every single day and every single week. And this would be a logical area for us to, just pause and digest these earnings. But, Apple looked really good today, which was, was kind of surprising that, how well it acted. And Microsoft the other day, that looked good. And it's hanging in there. But they have some room to kind of, digest those gains.
Yeah, I think actually even I just pulled up the chart of Microsoft on the daily. That's actually a good example of where the stock reported earnings last week. They gapped up, and they're now starting to come in a little bit and undercut the lows of that gap up day, maybe. Yeah. And it's not a surprise. It's gone on such a great run like a lot of other stocks.
Yeah, I could just pause out here and. When you're looking at the market averages, I like to look at the biggest cap stocks. And then I also look at all the Dow stocks from the highest price. And that gives me a feel for what's going on in the market. And if you do that, it looks like things just need to digest a little bit. Like the Microsoft, it's great. It had a nice gap up, but, it could go sideways for a few days or a few weeks and still be completely healthy. Let the moving averages catch up to it. And then we've lost a few, like, Google got hit and, not that it's terrible, but, that's going to have to, spend some time in the doghouse.
Yeah. And the nice thing is that if it consolidates, it's going to give us more opportunities and maybe new bases form.
Yep.
And then now we can start to add positions or even get into some of those stocks that we might have missed out on during this pretty incredible rally over the last first few months.
Yeah. A lot of, there are a lot of the software stocks that kind of have just been kind of setting up, giving you a chance to get in them if you missed them the first time. And so a lot of things are still looking, like really good. I don't want to sound negative, but, we've just had, a couple bad days in a row, and you just need to be, taking it day by day.
So, Mike, you mentioned something interesting when we were going over what we're going to talk about today, the weekly chart on the NASDAQ.
That's right.
So let's go over that again, because I think that puts it into perspective where we are in this market and maybe where we could go in the future.
Yeah, so you always want to look at things on a daily basis, but it's really worthwhile to step back and look at weeklies and monthlies to get a context for what is going on. And there's so much talk in the media, the financial media, about how we've run up. We're up so much for the year. Well, that's because we started the rally on January 4th,
right,
the very beginning of the year. So it's been really powerful. we're up a whole bunch for the year. But if you step back and look at the weekly of the NASDAQ and go back to, January of 2018, so back quite a ways, and we're only up like 5.5% from that point. So we had moved up, and then we came down the last quarter of 18, and that was devastating and quick. And then so now we've recovered, and a lot of good things have happened in the meantime, between the tax cuts, the deregulation, North Korea kind of was off the table for a while. We've got new things now, Venezuela, and Russia's starting to get involved there. So it kind of feels a little spooky, but a lot of the Mueller report is pretty much off the table. They're going, the whole AG is talking now, but a lot of unknowns are behind us.
Uncertainty it's starting to be removed from the market.
Yeah, and now the China trade deal, that should be happening soon, one way or another, and that'll be very telling.
Right, and so during this whole time and even the Fed, hopefully the Fed, you mentioned Fed Chairman Powell earlier, hopefully he won't spook the market like he did in 2018, at the end of 2018, but all that uncertainty being removed, that gives more confidence to the market, and these larger institutions who are responsible for driving up these markets, now they can put even more money to work with that certainty there.
Yeah, and look, the economy is good. We saw the GDP numbers, that just came out, and earnings for the most part have been solid, So there's a backdrop for us to, continue this move up, but you do need to take it day by day.
Now, one other kind of, hint or symptom of this market acting pretty well, besides the market doing amazingly well since the beginning of the year, there are a lot of IPOs that have come out lately. And this is all the talk in the media, in the news, anything stock related. Everyone's wondering about, the one that's going to come out in a few weeks, Uber. Right, but there are a lot of
what's that?
there are a lot of stocks that are new companies, new innovative companies that are coming out on the market. And one thing that we're definitely hearing at MarketSmith and IBD is, how do you handle them?
Yeah.
And so let's go into that a little bit.
You know what? IPOs can be very easy to trade. I've studied them in depth and put a lot of time into it. And it's scary for a lot of people. And they should be scared, because if you don't do it the right way, you can get really, really hurt. And so there's a right way and the wrong way. The right way, in a nutshell, is just wait for an IPO base to form and buy it as it breaks out. And make sure you cut your loss, because when an IPO base fails, it can get really ugly really fast. And that'll save you. We had Lyft that just went public, all the fanfare, and it reminded me of Facebook, back a few years when that went public and everyone was, all excited about it. And it didn't form a base. It just, it went straight down. And that's all Lyft has done, is gone straight down. And so you don't buy it until it actually forms a base. And we're going to talk about a few of those in a little bit.
But I use Lyft all the time, Mike.
I use Uber, and I didn't even know it was going public. No, I did. So what happened with Lyft is, in my opinion, is they just priced it wrong, and that's a little. It's very tricky for these underwriters to get the right amount of shares out there at the right price. There are all these moving parts, and the other ones we're going to talk about, it seems like the underwriters priced it properly. So if Lyft would have gone public at maybe 50, you would be looking at a completely different chart. So at this point, you have to stay away from it. It's down 33% off its highs. There's no reason to buy it. And of course, Uber's going to be coming out, and so we're going to see how that trades. But again, with Uber, you're not going to buy it on the very first day. You got to wait.
Yeah, and so let's go back a little bit. Let's just first go over the IPO base. Why don't you give a quick definition for those of the listeners who are new to this? Because this is by far our shortest base, right?
Yeah.
It's usually the flat base. Everyone knows is the shortest base, but this is a base that was kind of unveiled maybe in the mid 2000s. So let's just go in the definition, and then we'll go a little bit more in the history.
Yeah. Well, probably the best way of looking at it is probably looking at Google, and so we're going to be talking about that in a second, and maybe we go over that and walk through that chart, and I think that's like picture perfect a definition of what an IPO base is. And so we can pull that up in a minute.
Yeah, so Google went so back in 2005. Google,
It was
it was
2004, I believe.
2004, right?
Yeah.
Yeah. So 2004, Google formed this really short base, but so around, let's see, around 15 days or
Yeah. It
three
was,
weeks, right?
yeah.
Or 3 weeks, right? So that's in many ways is the shortest kind of base that we're going to use to buy a stock at that point, right?
Exactly. So when you're looking at an IPO, you might want to print off this Google chart, go into MarketSmith, do a change date into, I like using October of '04, and then maybe have that next to your computer and just say, you know what, this is what I'm looking for. This is the model. So the company goes public, runs into some form of resistance in the first 25 days typically, and it'll come down. And this is the way you'd like it to come down. It only came down like 12, 13%. And then in this case, since it didn't undercut the absolute lows of where it first started trading, that's another good sign. It was high price stock. That's another good sign. It was big and liquid for an IPO, which is what you want to see. That's your institutions in there. And it jumped up on the first day. So it had all these characteristics of what we found out, or the model stock. And this is what it was based off of. Now, in-house, all the portfolio managers, including myself and Bill and everybody, we bought that as it was breaking out there. And we, the firm made a lot of money on it, but we weren't really operating on rules because we didn't have that IPO base rule at the time.
Yeah.
So afterwards, I spent months and months and months. I just got lists of every company that had ever gone public, whether they're still around or not, and pulled them up and studied the first year to try to build up these rules and find out what an IPO base is. So this is what it is. Google is the picture perfect, runs up for 5 weeks, comes back down. Typically, 10 to 20% is your sweet spot. Some can go down to 50%, but that's in unique situations and bad bear markets. And you buy it as it goes back up through resistance, which is typically your old high, the original high that it stalled out at. Sometimes you can get cute and use some alternative pivots, but only after you've been doing this for a while.
Right,
so you buy it right there. And then your sell point, of course, always 7%. But if you undercut and close below the low of that pivot day, that's your first line in the sand. And you need to start exiting some of it because it's telling you that it's not working out.
Yeah, and as I always say, the best stocks, when you're in the right market, they give you one chance to get in, and then they're gone, right? And so if they're not doing that, something could be off, and you have to be flexible and react to that. So let's take a quick break here.
Okay.
We'll continue the conversation for IPOs in a second, and we're going to talk about something fun too, Mike. We're going to talk about expensive coolers.
I like fun.
And how you can make money, and we'll talk about this more after the break.
Okay.
Hey guys, Arusha from Investing with IBD here. The global economic cycle is moving into its later stages, creating a less favorable mix of growth and inflation. Central banks aren't providing as much fuel to keep things moving either, and market volatility has come back in a big way. All of this makes investing a lot more challenging today. AllianceBernstein can help. AB is a global investment manager with the tools and expertise to get portfolios ready for a more difficult path ahead. That means finding stocks from companies that are able to deliver quality growth over time. Adding downside protection against market downturns is critical too. And even though interest rates are rising, investors shouldn't avoid duration in their fixed income exposure. The bottom line, investments will have to work harder to generate long-term returns, but that shouldn't mean that investors have to struggle to find answers. AB offers actively managed flexible investment solutions across asset classes. It's what you need to adapt your portfolio for late cycle investing. To find out more, visit abfunds.com. We're back with Mike Webster on Investing with IBD. And Mike, let's continue with IPOs. And you mentioned research before. We have you had some really interesting research on long-term winners when you compare all of the bases.
Yeah, this is, back when I built the pattern rack, decade ago. One of the reasons that intrigued me is I wanted to test out all sorts of different things with the bases. And one question that, would always come up is one base better than another? And so now that we had a computer that could recognize all these bases, and it recognizes IPO bases, cups with handles and everything, that we could go back and test it on all stocks. So we went back to 1963. That's when our core database starts. And we studied every pivot that broke out, every stock with a pivot above 10 bucks, and then looked at their performance. And one way we sliced it was how many stocks ended up doubling before they went into a serious correction. So we looked at all the different bases, and as it turned out, the IPO base, as we're showing right here, 12.4% of the time, it ends up doubling from the close on that pivot day. And so that by itself wasn't a big deal, but compared to all of the other bases, it really told you need to pay attention to these IPO bases. A stock can have tons of cups with handles and flat bases, but it can only have one IPO base, right?
Right. Yeah. And as a comparison, so 12.4% for IPO base, 9.2% of the cup with handles went on and doubled. And so for those of you who are listening, when you get a chance, you can go to investors.com/podcast and take a look at this chart on the research that Mike did over the years.
Yeah. So there was a lot of things that went into to the study, but it's nice to walk away and see that, 8.4% of all bases end up going on and doubling in price. And so that tells you, there's this opportunity to make a lot of money, but also, 90-some% of them aren't going to double. So you need to, take profits and you need to cut your losses.
Right. Yeah. And what's so funny is Bill O'Neill, the founder of IBD and MarketSmith, came up with all these rules without all this research, right? And he said, okay, you take most of your gains at 20%, cut your losses at 7%. And now when we have all this technology and looking at all this data, it's just validated everything.
The coolest thing was Bill had this thing of, the relative strength of 87 was like this key number that, that he just had. He's such a genius that he just has a brain like a computer, and he just stored it. He's like, 87, that's the key. And then when I did this exhaustive, study, it was 87. I was like, wow, I guess I didn't just need to listen to Bill.
That's true. He was doing all that studying just by looking at all those charts.
That's a true genius.
Exactly. And Mike, you mentioned cool. And so I want to take that a little bit further and let's talk about...
You're super cool. You know that.
Well, thank you, Mike. But you know what's even cooler than me? Yeti coolers.
That's true.
And so let's go into this because this is a new company that came out maybe 6 months ago. And I think there are a lot of lessons here to learn from this IPO. A strong brand name. They've been around for a while. They have a great following. It's almost a cult. That's what we were talking about, right? And that's what you want to almost see, right? This brand loyalty is really strong. But they come out public, and what I like about it, they're very expensive. I don't have a Yeti cooler. I don't know if you have one, Mike.
Dude, I'm too cheap to buy a Yeti cooler. That's not going to happen. Man.
But
you can give me one.
Yeah, that's right. It would be nice if they gave me one too. But the thing is, they're so expensive that I'm not going to try it. But a lot of times, these really expensive products that come out and they have this great brand loyalty, they have the potential to become really strong stocks.
Yeah.
And so this was on my radar immediately when it came out, just because I didn't even know what it was really. I didn't know why, but I just recognized the name. And so they came out and they have I think just by looking at the chart, let's go over some of the lessons that you can learn from the IPO here, because this is the magic of trading right here and how you become a better trader by listening to these rules and really being flexible.
Yeah, well, I kind of got hung up on the price of the cooler when I was looking at this at first, and I had a bias against it, which is something to always remember, that to try not to have just random biases, because there are so many. Even though I don't want to spend $300 on a cooler, there are a lot of people who do.
Right.
A lot of people are going to be in that niche like you talked about. So looking just at the chart at the very beginning when it went public, it was a bad IPO base. So we just looked at Google and that was a good IPO base. So what makes it bad is it priced out at $18, but it went public trading below that. So the people who got the shares, before it's on the open market, they pay 18. Now it's trading at 17 and 15. they're all underwater. And so they,
And who are the people who are usually buying it at that point before it actually goes IPO?
those are the big guys, right? And girls. And they're in there and they've got their, their allocation that are in there, they want 500,000 shares, maybe they get allocated 200,000 shares. And so it goes public. Now they have to buy in in the normal trading, like you and I are doing it because we don't, participate in IPOs.
Yeah.
And that pushes it up because they want more of their allocation now. If you get, try for 500,000 shares, you get 200,000 and it starts trading down, are you going to want more?
No. You might even be upset. If it goes down too far, you might be upset and start dumping it.
Exactly.
Right?
But that's what you don't want to see. That's what happened with Lyft,
Yes.
and that was big. And Jim Cramer talked about it a lot, and he does a great job with that stuff. So with Yeti, it did break out of that IPO base, which was the high. So sometimes your high can be your first day of trading. Many times they'll run up like 2 or 3 days, or like we talked about, up to 25 days before it peters out. So this was your first day of trading was your high, and then it kind of moves above that, and then comes back in, and then kind of resets its pivot. So every time it runs into resistance, if it comes back in, now it's kind of a new IPO base that is set up there. So it had this, ran up for a bit and had this crazy day on the day that the earnings came out. I remember that. It was just really like, this thing was a rocket ship and it came straight down.
Yeah,
like
the middle of the day, right? Yeah.
Like a lot of stocks did today, actually. So it came down and then it formed this cup with handle. So the IPO base failed. But, your first bases in the first year, a lot of those can be, very powerful as well. And it formed this cup with handle in there that it broke out of nicely. And
so let me stop you here for 1 second, Mike. Okay, so because the IPO, even after that earnings, it started to look like it was going to work. It immediately reversed and then looked terrible. Now, what do most people do at this point? They're going to take it off the radar. Oh, Yeti's done for a year or so.
You can't do that.
You can't do that, right? So if you like the stock, if you like the story, just keep it on a larger watch list and see, check it maybe every week, every few weeks to see if it eventually forms another base. Now, this one, in another like 3 months or so, the next quarter, it spent that whole time, and this was during that bad market too, the correction. In the fall of 2018, during that time, it did what a lot of stocks with potential do. It formed a base, and it formed a cup with handle. Next earnings report breaks out powerfully at that time.
Yeah, and that's why you want to keep an open mind and be flexible. I remember Bill O'Neill would always tell me, bend like a tree in the wind, and I've never forgotten that. You have to be flexible in so many aspects of trading, and if you're rigid, you're going to break. And just like that, the tree, it's bending, and I've printed off a bending palm tree, and I keep it next to my door. So every time I go out, I go, I got to be flexible,
So you must do yoga too, right?
No, that's Scott. I do sit on my computer.
Your fingers are flexible.
Yes. But anyway, so it breaks out really powerful. You have to be flexible and say, just because they're expensive coolers, all these other people love them, I went on YouTube and started watching videos of Yeti versus the Igloo cooler, and Igloo was better, but people are still paying up for this other one.
Right.
And Bill had a way of kind of figuring that out with stocks. And I remember Coach from years ago, around the time Google was going, I think it was. He realized that that was something that people were paying up for, and it took me a while to figure that out. With it, sometimes things can be, the same quality or even lesser, but people want to pay up for it. It's that brand.
The brand power. I mean, the one that comes to mind for me, we spoke about this in episodes before, Lululemon.
Yeah.
People willing to pay up $100 for yoga pants. Who would have ever thought that would work? But there was a market for that.
Yeah.
And
people believe that it
defines them,
quality.
right? It's also a lifestyle kind of brand, right? And Yeti, in many ways, is kind of falling that category.
Yeah.
Right. It defines their serious campers.
I was going to put a sticky label on this and say Yeti.
Yeti.
Just people think I'm cool.
That's true. I know. And it does have that kind of cool factor.
Yeah.
Kind of like Apple or Nike and things like that.
But at this point, I think the earnings come out tomorrow. So it's into this dangerous area with the way earnings have been
Right.
reacting, gapping up,
Well, it's
gapping
gone
down.
77% since the last when it broke out of that cup with handle.
What more do you want?
I know exactly. Yeah.
Yeah.
So there's a lot of expectations baked in
Yeah.
to the earnings, but for those of who are not in the stock right now, it always comes down to the same thing here. It's you have to be disciplined. You have to let stocks set up, and then you always have to always be aware of earnings.
Yeah. So it's not at a typical buy point at this point. So if you don't have it, you can't be stepping in front of that freight train. It's going to happen one way or another tomorrow.
So let's quickly talk about another stock, 10 Cent Music.
Sure.
And this one went on a pretty good run during the beginning of this year. And this is almost everyone loves to do these things, but it's the Spotify of China, right?
Yeah. That's how you can understand
exactly.
It. I don't think there's anything wrong with it.
No, but it's just funny. But yeah, they have a much larger audience.
Yeah. And they have that like tip jar thing that they do, right? Where the people pay.
That's right.
With this tiny little amount, but they could add up.
All these microtransactions and but I think the other thing with this, and it's just setting up right now, but back when it came out as a public company and it formed an IPO base, it's part of Tencent. Yeah. Tencent's one of the largest companies in huge, China, largest internet company in China, and so they already had this muscle behind it.
Yeah, so that was helpful. So then it becomes liquid. So whenever I'm looking at IPOs, one of the first things I do is I look at how liquid they are, because that's a sign of sponsorship. Remember, when you're trading an IPO, you're not going to have a lot of financials on it. You're not going to have all the ratings because it doesn't have enough time for them to be built. And the financials can be a little sketchy because the company doesn't always break out all the quarterly information. So you're operating a little blind in some key areas of Can Slim. But the volume, Bill would always say, the stocks with more volume, that's where the institutions are.
And so more volume or more dollar volume?
Dollar volume is the way I like to look at it. He would look at it just
both.
Straight
or
volume.
You just look at both. Okay.
But he would realize $100 stock is trading 100,000 is different than a $10 stock trading 100,000. So I like to look at the dollar volume. And so in MarketSmith, when people are looking at IPOs, just go to that section. You guys have a little tab for IPOs, right?
We have a list for IPOs, or you can screen for IPOs too.
Yeah, you can screen with custom screening. You can do anything, and just sort it by dollar volume and look at the most liquid first, and that's where you would have found Tencent. Now, what happened with this one? It had a pop on the IPO, so that's good. But then it came and it broke that $13 IPO price a couple days later. But you can kind of forgive it because it was during that bear market in the tail end of that. What day did that break that? That was December 14th that it came and broke that. That was right in the heart of the market collapsing, right?
Yep.
And so then it's set up, and this alternative pivot that you could have actually bought it before it went into new high ground. So when you get a chance, you look at the chart, it kind of looks like a double bottom that didn't undercut, and it set this resistance in the middle there at 1423. And so you could have bought it on that day that it was breaking that resistance.
As it got to the 1423.
And in fact, you could have even bought it earlier, anticipating that move because it had a little gap in the morning. And then it was going over some earlier resistance in that base. So if IPO bases are new to you, don't do this part. Wait for the old high. But study these, and you can get a head start on it by finding these alternative pivots in there. But you have to be really tight with them because many times it'll just be a head fake, and you have to be willing to be flexible, bend like a tree in the wind, and get out and then get back in if it breaks out of the standard pivot.
Yeah, and Tencent right now it went on a great run, consolidating that run, and we'll have to see. They reported earnings. Oh, when did they report earnings? Back on March 19th, so they have a little bit more time.
It was a bad reaction to the earnings, and it's doing nothing wrong. It's 13% off its highs. Could just be base building here, but there's no reason to buy it right now. You got to see if it forms a solid base.
Yeah, so another one to just keep on the watch list. If it's a great company, it'll break out again and give us all another chance to get back into it. So there are a lot of IPOs coming out. And so you want to make sure you know how to handle them. And as Mike mentioned, remember, they are more volatile, and so adjust for the risk. Coming up next, we are going to talk about a stock that could become the next Amazon, that could become the Amazon of Africa. So you don't want to miss this.
Okay.
Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. We're back with Mike Webster on Investing with IBD. And Mike, let's take this IPO discussion a little further and go into current stocks and talk about some current IPOs.
Sure.
So the first one we have is Zoom. Now, this is a company that this is actually a company that we use, a service that we use here in-house.
Every day.
Yeah, and we installed it maybe like 2 months ago, and it's great.
It's so good. We had this other, I don't want to mention the company, right? So bad. Every day, the conference, it was becoming a joke. Like the analysts here will do like a morning call. It's horrible. And they switched over to Zoom, and there's like a learning curve or whatever, but it's unbelievable. And now everyone's using Zoom. You walk around, people doing Zoom meetings like nonstop because we've got an office in India, China, and in London, Chicago. We're all over the place, Boston, New York, obviously. So it's, and a lot of companies are like us, right, that we're spread out. And so you need to do this video conferencing, and they're great at it. So far, so good, right? Yeah,
and I think the cool thing, because we're using this for all of our meetings, you can just bring any laptop, just go to the website, download the software really quickly, and it works seamlessly on any computer versus before there's all these wires you had to try to connect, and it would take you like 10 minutes to try to get your computer on. So the service is really good. Now, looking at some of the background for the story, Eric Yuan is the CEO and founder of the company, and his story is kind of interesting. He was one of the first employees at WebEx. Do you remember that company?
Of course.
And so WebEx, they were an independent company for a while. They were acquired by Cisco, and Eric stayed there for a number of years. And then eventually he realized that, this technology is falling behind the times. And so he kind of grabbed 40 or so of the employees at Cisco. And
that's not nice.
I know. And then started his own company and really built kind of this video conferencing software for now, the data centers, the cloud computing. So it's really kind of the first video conferencing software developed for the cloud. And so that's kind of their kind of niche right there. And
the cloud is such a big deal.
It is amazing, isn't it?
So many businesses are now based off of this thing that we didn't have before. 10 years ago, you say cloud. Well, look up in the sky. But you didn't know anything. Obviously Amazon and all. You have so many key stocks out there that are just formed specifically for the cloud.
Right, and I think it's a great lesson when you have some really large kind of catalyst going underneath in just the business. It takes a while for a lot of these businesses to adapt to it. And so I remember reading about the cloud maybe 5-6 years ago. I was like, okay, maybe that runs over.
Yeah.
And now you're only really seeing it happen because all these new companies are just emerging. It's kind of like with the iPhone when they released the App Store, right? A whole new industry started coming around and all these new companies. Now, same thing with the cloud. It's just this brand new way of thinking. And in the end, they're just kind of building a better, more efficient mousetrap. But more productivity goes up. But there are always going to be new innovative companies that come and all of a sudden just take a lot of that market share away because they've just developed something much better and cheaper than the competitors. And so Zoom potentially could be one of these stocks here. So, Mike, let's go to the chart and take a look at it. Now, with Zoom here, now this is one of the IPOs. Now, we didn't talk about this earlier, but a lot of IPOs, they don't have earnings when they come out.
Unfortunately, that happens a lot, and a lot more these days. And it makes it tricky because if you are an orthodox can slimmer, you kind of stay away from those.
Right.
But the reality is the market is kind of shifting more towards sales growth and story, and you have to decide how orthodox do you want to be. And there's nothing wrong with being orthodox and just saying earnings have to be positive, they have to be up 25%, and go down the list. You'll just have a smaller pool that you're going to be, pond that you're going to be fishing in.
Yeah,
but this one has earnings.
Yeah, and that's what kind of stuck out to me. It's like, whoa, here's a company that we're familiar with,
earnings,
and they actually have earnings. I know,
and strong estimates.
Right, and so that initially stuck out. So this has been on my radar from day one. Once I heard about these guys, they were coming out public and they had earnings. Now they did something interesting today, and I think this is a great example. We were just talking about IPO bases and really the minimum for an IPO base is 15 days.
Well, 10 days.
Or 10 days, okay.
10, Google was 15 days,
okay.
But 10 is where, when I studied them, 10 was kind of that cutoff point, and because we like to look at, 25 days or longer for our bases. So,
right.
Going to 10 was kind of, stretching it quite a bit, but I had enough, examples of them. 10's kind of the minimum. You have exceptions. And, sometimes it's 8 or 9 days, but this is really, short. It's only 5 days and it broke out.
Right.
We don't have a big sample size of those.
Right. And it was looking pretty good in the beginning of the day.
Yeah.
And then the Fed the Fed came out with news, and like a lot of stocks, they all kind of reversed. And so now Zoom. Well, there are a couple things here. So you mentioned, so this is only a 5-day kind of consolidation. So you're taking more risk there. Yeah. But if you were going to use it, the buy point was around 74.17, and it reversed and it closed at 72.76 right now.
Yeah. So how I would treat this, if you had kind of made the exception, like the one that I could think of that had a really short IPO base that worked was Acacia. It worked until it didn't have this huge move, and then it, of course,
it's a ticker symbol ACIA, and Acacia came out public in 2013, if I remember correctly.
No, I think it was more recent than
was it
that.
recent? 2015, maybe 2015. So when you have a chance, go back and take a look at that chart right there.
I'm just seeing when. It was like 2016.
Oh, 2016, okay.
But, time flies.
Seriously.
So, that had an example of a 5-day IPO base, and then it formed some other IPO bases. So it's worthwhile to go to Marcus Smith when you get a chance to do a change date and look at that. So this one, broke out. So if you wanted to make that exception and buy it today, you certainly could have. But, of course, the market brought everything down, like you mentioned. So it's in a vulnerable position. So you're already making an exception. So what I would do is I would use today's low as kind of your first line in the sand. If we get a close below.
So 70.82 was today's low.
Yes. And so if it closes below that, you just know, what, maybe this is now going to form an IPO base. And there would be nothing wrong with that. Like I said, it can hit the resistance in the first 25 days. So you don't want to give these things a lot of room, and you don't want to get sucked into a story. Lots of them will have great stories and ride it on down because you can look at. I looked at all of them, and so many great stories end up going down to $1.
Right.
But this was what was good about this is priced out at, I think it was like $36, and started trading above 60. Nice pop. Now what happened is, on the calendar, this happened after Lyft. So Lyft came, and it was a disaster. We talked about how it broke the IPO price. And so when this came public, those underwriters were like, I don't want this mess. So I'm sure they figured out how many shares they were going to offer, what price, to make sure that it was going to get this pop. Otherwise, if the IPO market really dries up, it can hurt the market quite a bit.
Right. So I think that the big key here, if you're going to take a little bit more risk, right, go smaller, but always have an exit strategy.
Yeah.
Right. If you have a good exit strategy, that gives you more flexibility to do things, right, and take a little bit more chances, bend the rules a little bit.
Yeah.
If I ever try something like this where I'm bending the rules, I always go in smaller too.
Yeah. And like you said, know your exit strategy. So your key points are typically your pivot day low and the day before your pivot day low. When they break those, regardless if it's 7 or 8%, and they close below those, that's your warning sign that, you know what, maybe this breakout is not going to work, and you can just move to the sidelines, and you can always buy a stock back. Be flexible.
Let's go into the next one, Pinterest, ticker symbol PINS.
Mm-hmm.
And, well, we're both kind of, we heard of the company, but last week when you were talking, neither of us really went to the website and tried actually the service.
It's so cool.
It is really cool.
I did not know what they were and what they did, really. I think I thought they were Etsy or something, and so I had no desire to go onto it. But when we were talking like the IPOs, I looked at it, and before you know it, half an hour is gone, and
Right.
I'm stuck on their site. So from a standpoint of using a product like Zoom that we talked about that we use and we can understand, the Pinterest, I was like, wow, I kind of felt like the first time I looked at YouTube and I saw some cat video. Someone said, you got to check out YouTube as a cat video. I'm like looking at it going, why am I watching a cat video over and over and over again, right? And you fast forward, now you always go. So now I'm going to be using Pinterest all the time. So now looking at the stock, it goes public at 19. The first day it pops up again, kind of similar to like what the Zoom and the Lyft debacle. And so they wanted to price it right. It gets this nice pop and is running up each day. You cannot buy it then.
Yeah.
And that's where you have to stay with, no matter, let's just say this thing goes up to 100 and never looks back. There wouldn't have been a chance to buy it properly. And you're taking on risk with IPOs. And you want to wait for a proper entry point, not just gamble. So you couldn't buy it, and it's gone from $25 to $35, and now it's coming down. Second day off the high, 11% deep at this point. So we're going to watch it and see what it does. And if it goes through, let's say it goes sideways for a couple of weeks, when it goes through that old high of 35.29, that's where you're going to be buying it. We've got to, we have some time, at least 8 more days.
Yeah, and if it turns out to be a great company and a great stock, it's going to give you a number of chances to get into it. And so you don't always have to get the bottom, which is the nice thing. Discipline is the most important thing.
Yeah, so looking at this, there was just not a proper way to buy this IPO without getting lucky.
Okay, let's go on the last stock here. Jumia Technologies, ticker symbol JMIA. And this could be the Amazon of Africa.
Yeah, it's really interesting. They're 100% in Africa. And they're based out of Europe, but they do everything in Africa. So they have workers in Africa, but all the other work is done in Europe. And so Africa's new as far as e-commerce goes. And so they've got the first mover advantage there. Now, obviously, you always risk Amazon coming into anything, and if Amazon went there, this thing is going away, right? But right now, it's formed this IPO base where it ran up for 3 days, hit resistance of 49.77, priced out at 14.5. So, this is, up quite.
It's a big jump, yeah.
That's a big, big move. And if you look at the chart, you could see on there some alternative pivots that you could have bought it 2 days ago as it was going through the high of the second day. It's kind of tricky to, with this, there is an art.
So the high of on April 26th at 40.95.
The resistance that I would have used, I would have been looking at April 16th and that high of, the 43.50 high. When you went through that just 2 days ago.
Okay.
So, we both know charts inside and out, and you're looking at it differently than I am. I see that other alternative pivot there that you were talking about. And that's one too. I would have just waited a little bit more for, have a little bit more evidence. But that's intricate. But really what you're looking at is it going through its standard pivot of 49.77. Now, this is a wild one. It's deep. It went from 49.77 down to, 31.70 in 2 days. So you're playing with fire with this one.
36% depth on the base.
It's crazy in such a short period of time. So this is high risk, high octane name. And the numbers are just the numbers are out so far are just look pretty bad as far as the the earnings. They're losing a lot, but so did Amazon at the beginning. So this is a high flyer, interesting concept of trying to tackle Africa, and they've got the first mover advantage, but they've got a lot of work to do because Africa's huge, and they're only covering I think about half of it or so.
Yeah, well, they have it looks like they have operations in 14 countries, and they've done business with 80,000 local African companies in 2018. So they are making some headway right there. And one final kind of interesting point here that I saw, Golden State Warriors basketball player Andre Iguodala joined their board of directors.
Wow.
Which is, it was kind of interesting. I think in many different ways. Those guys are based out Golden State's in the Silicon Valley, and here he is there.
Cool.
So he's going to kind of be like an ambassador for the company and maybe try to get it more brand recognition there. So that's it. And so a lot of IPOs out there, they have a ton of potential, but we mentioned it a number of times during this podcast.
Be careful.
Be careful. Do that research, okay? So, Mike, thanks so much for being here. Next week, we're going to have Chris Gessel back on the podcast, and Chris and I are going to talk about taking profits. We'll also have Randy Watts. He's going to be back, and he's going to do another interview with Alliance Bernstein. So that's it for this week's episode of Investing with IBD. I'm Arusha Pierce, and thanks for listening. And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.